Now see here friends, in this slide there are 4 questions. The first question, we will read the first question. Okay, read. Dash is defined as a measure of the variance of domestic currency, value of an asset, liability or operating income that is attributable to unanticipated change in the exchange rate. Okay, you can see the question first. Okay, see what is being given. There are 4 options also given. The answer for this is foreign exchange, the foreign exchange risk. So why foreign exchange is because it's about domestic currency, value of an asset, liability, operating income that is attributable to unanticipated, which is not been anticipated or forecasted, the change in exchange rate. Exchange rate itself means foreign exchange risk. Foreign exchange risk. Thus the answer will be foreign exchange risk. But why this risk is because that the movement in the exchange rates between two currencies may adversely impact the status of it. Okay. Then the next question, investment in post office time deposit is dash. Which risk? Investment in post office itself means zero risk. Okay, itself means zero risk because it's a government. It's a which risk? Zero risk. It's no risk. So the answer is A, zero risk. Why? Investments in as well as investments in guaranteed by Government of India, that is government securities, are considered as having zero risk from credit risk angle. If you see from credit risk angle, it will be zero risk. Next comes 11% Government of India, that is 11% of GOI, Government of India security, is quoted at rupees 110. The yield, that is the interest, will be dash. How much will be the interest? Okay, see 110, 11% is the rate of interest, Government of India security. So it will be the answer will be, how much the answer? The answer will be 10%. It's defined here itself because it's been 110, 11%. So see here, yield, that is B. Why? Yield is calculated as the income received from the investment. Yield, how is being calculated? Income which is received from the investment divided divided by the price of the instrument. Okay, what is the income? What are the income received from the investment divided by the price of the instrument? Thus, the security pays rupees 11 and cost rupees 110. Therefore, the yield will be, can say the income received from the investment is 11 divided by the price of the instrument is 110. In percent, if we say it will be 10%. So, answer will be B, 10%. The next question is, see, ICAAP means, that is ICAAP. The full form is, there are 4 options given. What is ICAAP? As a banker, you may be aware of what is ICAAP. See, there are 4 options given. The first option is internal capital assessment adequacy process. Second is internal capital adequacy assessment process. Third is international capital adequacy assessment process. Then the fourth option is imaginary capital control assessment process. Now, which is the answer here? The answer is B, because all banks are required to have an ICAAP in place. All banks are required to have an internal capital adequacy assessment process. All banks are required to have an internal capital adequacy assessment process in place. Okay. Now, in our next slide, there will be few questions regarding the risk management frequently asked, which is important for your upcoming exam. Hello friends. Now, in this class, we will see risk management. That is, in this video, we will see risk management frequently asked questions for CIIB bankers. Those who are going to write the exam for the upcoming exam, risk management paper. It's a part 4 we have released. Okay, you see here, this is our 48th question. Just read the question. Any term deposit for value of dash crore and above is defined as bulk term deposit as per RBI guidelines. Now just see here, there are 4 options given. You can see in the screen, the answer is also been highlighted in red color. Don't see directly the answer. Just read the question by yourself first. Then go for the answer which we have been highlighted. The D, that is rupees 1 crore. So why 1 crore is because why the answer is D. Any deposit of value rupees 1 crore or above is considered as a which deposit? Bulk deposit is considered as bulk deposit. Okay, therefore any term deposit for value of 1 crore and above is defined as bulk term deposit as per RBI guidelines. Thus the answer is D, rupees 1 crore. Moving back to the next question, that is premature payment of a term loan will result in interest rate risk of which type? Of dash, that is embedded option risk. Why? Because see, embedded option, what is that? Embedded option brings uncertainty into the calculations. It brings uncertainty into the calculations as the inflow and the outflow of funds, inflow or outflow of the funds could be different depending upon whether the embedded option is exercised or not. I will explain you this. See, premature payment of a term. Okay, premature payment of a term loan will result in interest rate risk of dash type. It's an embedded option risk. Why? Because the word embedded option, it brings uncertainty into the calculations. Which calculation? Funds calculation. Which funds calculation? Inflow or outflow of funds. Either of the one could be different depending upon whether the specific embedded option is exercised or not. And the next question, right to buy under currency options is currency option. Okay, right to buy. Buy means it's always call option. If it's sell, that means put option. Rest. So right to buy. Buy means call. Buy means call. Okay. So that's why the answer is call option. The holder of a call option has the right but not the liability to buy. Please make it clear. The holder of a call option has the right but not the liability to buy the underlying asset at the strike price, at the exercise price. Okay. The opposite of it, right to sell, is known as which option? Right to sell is known as put option. Why? Because the holder of a put option has the right but not the liability to sell, because it's a sell. To sell the underlying, that is the sell the underlying asset at the strike price of the option. Strike price is nothing but the exercise price of the option. In this slide, there are 4 questions. Moving back to the next slide, we are having more questions. See now friends, here the 52 question number 52, expand ICC MCS. So what is ICC MCS? Okay, what is the full form? There are 4 options given. International Conference of Capital Measurement and Capital Standards. Second is International Convergence of Capital Measurement and Capital Standards. Third is the International Conference of Capital Measurement and Capital Stability. And the last option is Indian Convergence of Capital Measurement and Capital Standards. Now what will be the answer here? ICC-MCS. This is a main term. How? So what is the full form of ICC-MCS? The answer is B. International Convergence of Capital Measurement and Capital Standards. ICC-MCS, International Convergence of Capital Measurement and Capital Standards. So what is this? This is a document which is released by the Basel Committee on Banking Supervision. It's called BCBS, Basel Committee on Banking Supervision, and is the foundation of international approach for capital adequacy standards across the world. Okay, that's why. Just see here, ICC-MCS, International Convergence, International Convergence of what? Of Capital Measurement and Capital Standards. So this is a document which is released by the Basel Committee on Banking Supervision, BCBS, and is the foundation of the international approach for capital adequacy standards across the world. The next question of this slide is, what does RCSA refer to? What does RCSA refer to? RCSA means what? There are 4 options given. It is based on risk. So the answer is B. Risk and Control Self-Assessment, RCSA. Risk and Control Self-Assessment is a standard tool for operational risk management. This is very important question. Risk and Control Self-Assessment, RCSA, is a standard tool for operational risk management. Under this, that is under RCSA, is a product, you can say a product or a process or an operational risk area is selected and studied to identify the inherent risk involved. The control measures are been applied or has been applied that are in place to mitigate the risk. So the effectiveness of these controls and the net resultant residual risk left to be faced by the whom? By the bank. Okay, I would repeat once again. The answer for this is B. Risk and Control Self-Assessment, that is RCSA. It's a standard tool for operational risk management. Okay, under this you can take anything, any operational risk area or any product or any process which is been studied and it's been identified. Why it's been identified? To identify the inherent risk involved in that, and accordingly control measures are been taken place that are in place to mitigate those risks. So the effectiveness of these control risk, that is the control measures, and the net resultant residual risk, left to be faced by the bank. Now look here friends, this is our 54th question. Just read the question first. Failing to take appropriate measures to protect assets, like for an example, IPR, intellectual property rights owned by the institution, is covered under which risk? Is covered under, it is a legal. So that's why legal risk. Every institution should have a necessary copyright and other measures in place to legally defend its intellectual property rights, IPR, and hence it is classified as legal risk. Okay. However, friends, listen carefully. However, failure failure to protect the assets, say failure to renew the insurance of a branch premises, or you can say a cash in transit, could fall under operational risk, not under legal risk. Okay. So what falls under legal risk is an institution should have its necessary copyright and other measures in place to legally defend its IPR, and hence it's classified as legal risk. However, failure in general to protect the assets, say the failure to renew the insurance of the branch premises or cash in transit, could fall under operational risk and not under legal risk. Okay. Then what is classified as process management? What is classified as process management? Even types of operational risk. What is classified as process management? Even types of operational risk under Basel II. There are 4 options: accounting errors, fiduciary breaches, vandalism, product defects. So the answer is the first, accounting errors, is because see, Basel II category of operational risk event. Basel II category, okay, just listen, keep in mind, Basel II category of operational risk event types include execution, it's included execution, delivery and process management, that is EDPM. Yes, EDPM, execution, delivery and process management. So execution, delivery and process management. E stands for execution, D indicates delivery, P indicates the process, M indicates the management. Thus EDPM, execution, delivery and process management. Then the transaction capture and execution is one of the subtypes under this EDPM. Thus the accounting errors fall under this subcategory. Fiduciary breaches and product defects too are operational risk events, but they fall under the main category claims. Understood the difference, friends? See, accounting errors fall under this subcategory. Which subcategory? The EDPM subcategory. Okay, accounting errors. Thus the answer is accounting errors. And with regard to the fiduciary breaches and the product defects, these two are in operational risk, that is the operational risk events, but they fall under the main category. Okay, main category. Then products and business practices category also they fall. That is the main category. Which category? Main category means the clients, products and business practices category. The next option, that is the vandalism. What is that? This is also an operational risk event under the main category of damage to physical assets. Vandalism is damage to physical assets. Okay. The next question, moving back to the next one. Which one of the following is not one of the pillars under Basel II? Which one of the following? Minimum capital requirement, supervisory review and evaluation process. These are the in part of the Basel II pillars. So the question is which is not. Okay. Market discipline. Market discipline is also there. Market review. Market review is there? No. Okay. So the answer is D. Market review is not there. So answer is D. So the three pillars under Basel II are the minimum capital requirement, supervisory review, evaluation process and market discipline, not market review. The last question of this slide is CRAR. CRAR. Friends, what is CRAR first? CRAR is capital to risk weighted assets. RWA, risk weighted assets ratio. Okay. See, CRAR, capital, that is C stands for the capital to risk weighted assets. Risk weighted assets stands for RA. Risk weighted assets, then R, ratio, risk weighted assets ratio. Okay. The capital compromises of tier 1 capital. This is just for your information I am saying you. CRAR is a tier 1 capital plus tier 2 capital after adjustments as per regulatory prescriptions. Please keep in mind the capital compromises of tier 1 capital plus tier 2 capital. Okay, tier 1 plus tier 2 after adjustments as per regulatory prescriptions. After adjustments as per regulatory prescriptions.